Today, we're taking a look at a stock that, in my opinion, is much more interesting at its current price level than Nike. We're talking about Deckers Brands, which is basically a shoe retailer. And whenever I say or hear shoe retailer, I immediately think of Al Bundy. If any of you still remember Al Bundy, feel free to mention it in the comments. But back to Deckers Brands. They bring together the well-known brands Arc, Hoka, and Teva, and are a premium shoe manufacturer whose stock price has recently taken a significant hit. Back in January of this year, the high was at $223, and now it's down to $88. That's a drop of 60%. In the long term, things are looking very, very good. Since 2016, the stock price kept climbing, and even after the crash, it's still up by 1,000%. At one point, it was up by almost 3,000%. So in the long run, it's still a very, very strong performance. But in the past few months, things have dropped sharply, which could potentially be an interesting entry point for value investors. This means the current market capitalization is still just under 13 billion US dollars. They don't pay out any dividends, and the current PE ratio is about 13. And it's not just the stock price that has performed well over the long term, but also the operating business itself. We can see that here. Revenues have risen from $1.5 billion in 2013 to about $5 billion now. Net profit has grown from just over $100 million to more than $1 billion. And net margins have increased from just under 10% back then, which was already good, to now 17 to 20%, which are extremely strong margins in the apparel industry. There haven't been any dividends over the years, but instead they've consistently bought back shares. Back then, there were still 207 million shares outstanding, and now there are only 150 million. Or, as we'll see in the quarterly report in a moment, even fewer. But first, let's take a look at the financial situation as of September 30th, 2025. They have $1.4 billion in cash and no financial liabilities whatsoever. In addition, all liabilities, meaning both short-term and long-term, are about just under $1 billion plus $350 million, so roughly $1.3 billion in total liabilities. And in contrast, they have those $1.4 billion in cash alone. So with their cash, they can cover all of their liabilities. And that means the financial situation here is very, very good. That's why we can go ahead and jump right into the income statement. On the left, we see the last 3 months, so the quarter that ended at the end of September. And on the right, we see the first 6 months of the year. So Deckers' fiscal year actually begins on the 1st of April each year. And in the first half of the year, they were able to increase their revenue from $2.1 billion to $2.4 billion. They managed to increase their net profit from about $360 million to around $410 million, or earnings per share from $2.34 to $2.74. And even in the last quarter, we see growth rates here. In the second quarter of 2024, revenue went from $1.3 billion to now $1.4 billion. And net profit also increased from $250 million to just under $280 million, or from $1.59 to $1.82 per share. And here we also see the share buybacks. Last year, there were still 152.8 million shares outstanding here. Now it's only 147.65 million. These are always average values here in the last quarter. In reality, it's actually even fewer. For that, we can scroll all the way to the top. And we see here, now there are only 145.7 million shares outstanding. And with that, over the past 12 months, they bought back about 3.5 to 4% of their shares. And that's a nice payout. And honestly, I even prefer it to a dividend at this point. Then let's also take a look at the cash flow statement to see if they really have enough money for the share buybacks, or if they have to dip into their cash reserves. And we can see here that in the first half of the year, they only had an operating cash flow of $44 million. Out of that, they needed $45.9 million for investments in property, plant, and equipment. That means the free cash flow was slightly negative, or I'd say pretty much exactly zero. And yet, they still bought back nearly $500 million worth of shares. At first glance, it looks like they can only finance these share buybacks with their cash. But at this point, we need to take a closer look. Specifically, we see that they increased their inventory by $340 million in the first 6 months. And they did the same thing last year when it was $300 million. So they are producing or buying more and more goods, stocking up their inventory. And that makes sense, of course, because the holiday quarter is at the end of the year. A lot of products are sold then, which is why inventories are built up here. Then, in the following year, these are reduced again, and it all balances out over the year. And that's why we can't just look at the first 6 months and draw conclusions from that. Because without this buildup of inventory worth $340 million, the free cash flow would be about those $340 million. And only a little over $100 million would be used from cash reserves for share buybacks, and not the full $460 million. We can also see this here if we take a look at the cash flow statement for the full year 2025 and the 2 previous years. And there we see that this inventory position always more or less balances out to zero. Sometimes a bit negative, sometimes a bit positive, but over the whole year it's close to zero. That's why we can set it to zero for the current half year, since we know that in the second half of the year it will go in the other direction. And then in recent years, they achieve very, very high free cash flows here. Here, they have an operating cash flow of $1 billion in 2025 and also $1 billion in the previous year, with hardly any expenditures for investments in property, plant, and equipment, so the free cash flow was each time a solid $900 million. In 2023, it was a bit less, but still around $450 million in free cash flow when we subtract these two numbers from each other, so very, very positive free cash flows. And part of this was used to buy back shares, but not all of the free cash flow. We can also see down here that the cash position has continued to grow, since they simply kept the remaining cash. In 2023, they initially had cash of $840 million, and by the end of the year, it was almost $1 billion. In 2024, this amount increased to $1.5 billion, and in 2025 to $1.9 billion. And in my opinion, management did a really, really good job with this. Because if we look at the stock price again, as the share price kept rising and the valuation got higher, they didn't use all of the free cash flow to buy back shares. And now, with the stock price down, with prices lower, and the valuation level lower, they're not just using the free cash flow, but also the cash they've accumulated over the previous years to buy back their own shares on a large scale. And that's what I call smart capital allocation by management. And from my perspective, it's a very, very positive point. We can also take a closer look at the valuation level. Down here, we can see the P/E ratio. It was still around 30 in 2024, and the year before, it was somewhere between 20 and 25. And now, due to the massive drop in the share price, the P/E ratio has fallen to 13. Now, management is buying back their own shares on a large scale. But we can also see that profits have continued to develop positively. The middle chart shows us this. Profits have kept rising, but the market sentiment toward Degas brands is now much worse. That's why many people have sold, many are more fearful here, and the valuation level has dropped significantly. And that's just how the stock market works. During hype phases, people buy, no matter what the price is. And when the mood shifts, panic sets in and people start selling. And again, it doesn't matter what the price is. No matter how low it gets, they sell and the prices keep crashing. And as a value investor, you want to do exactly the opposite. That means when there's euphoria in the market and prices are high, you should be selling. And when the mood is bad and prices are low, that's when you should be buying. And that's exactly what I've been doing for over 10 years. But why has the mood gotten so much worse now? On the one hand, it's because people have suddenly become afraid of currency effects. But there's also fear about the tariff issue, meaning import tariffs that have to be paid when bringing goods into the USA. This can lead to problems that might cause revenues to drop, or of course, profits as well. And that's exactly why people have become extremely panicked here, and valuation levels have dropped by almost 2/3. But even so, we shouldn't forget that the outlook Degas Brands is giving here is still very, very good. They are expecting earnings per share of $6.30 to $6.39 for the current fiscal year. And that doesn't even include the share buybacks that are still to come. That means they're probably going to continue buying back shares. That means earnings per share will likely be even higher, maybe around $6.50 to $7. And then we're looking at price-earnings ratios roughly between 12 and 14, which is significantly lower than what Degas brands has seen in the past. Analysts also continue to expect that earnings will rise. This year, they're expecting $6.41, next year, $6.80 per share, and then $7.55. So here we have a very strong brand that's expected to keep growing, using a lot of money for share buybacks at lower valuations. And that currently makes the stock an interesting investment opportunity for me. But you also shouldn't forget about the risks. We're in the fashion industry here, and that's a very, very risky business because trends can always change. That means certain brands could be out next year, other brands could be in, and then sales and profits can quickly collapse. For this reason, I would never invest large sums in the fashion industry. But if you want to invest smaller amounts here, then Degas Brands is definitely an interesting option at the moment. If you want to know what I recently bought for my community portfolio, feel free to check out this video next. And I'll see you next time on German Value Investor.